Hey, welcome back. Today we're going to talk about how to build capital for real estate investing. So if you're a real estate investor, whether you're just getting started out or you've been doing this for a while and you've run out of cash for deals, you've self-financed or you just don't have cash available, you might be asking, how can I build up capital to buy my next deal and the deal after that? So that's what we're going to take a look at here today, is a number of different ideas, kind of traditional as well as some creative ones, around how to build up your capital nest egg so you can keep moving forward and buy more properties. Stay tuned. All right, so you might be asking, well, Dave, you're kind of the raise capital joint venture kind of guy. Why are you talking about saving up and creating our own capital to do deals? Why don't we just tap into OPM, other people's money, right from the get-go, right from day one? Good question. Here's why. I firmly believe that wherever possible, you need to have your own financial skin in the game, at least for your first deal. All right? That shows that you're serious. That shows prospective investors that you're keen, that you're willing to put your own money where your mouth is, so to speak, and you're willing to take financial risk for your own real estate investing business. And here's the thing. When you got your own money into the deal, you pay very close attention to how things go. So if you're just getting started with real estate investing, wherever possible, I highly, highly, highly recommend self-finance your own deal. I know that sounds a little bit weird coming from the raise capital guy, but I tell you what, it makes it so much easier to raise capital moving ahead because you can point people to the deal that you've already done as proof of concept. If somebody says, hey, Dave, how much money are you putting into this deal? You can say, well, I'm not putting any of my money into this deal because I've got it all tied up with this other one. That's why I'm giving you the opportunity to invest with me in this new deal. Does that make sense? So that's just kind of to set the stage for this, this information here. Okay, so let's take a look at some different ways to come up with the money to build up the capital to do your next deal. So the first thing you want to do is come up with a long-term plan, a long-term financial plan for real estate investing. What is it that you want to accomplish? What is it that you want to do? What kind of real estate deals do you want to do? What are the price points? How much money do you need? And really focus on saving up the money for that first deal. If you want to end up doing 5 or 10 deals, don't worry about saving up all the capital for all of them. Just save up enough for that first deal. Or as my friend Barry McGuire says, get that first damn deal done. That's our whole goal here. So let's come up with some ideas on how to do that. All right, the first suggestion I come up with is one that's not really popular with most people, myself included. It revolves that dirty B word, budgeting. That's right. So chances are, if you're like I was back in the day, you might have been a little bit loosey-goosey with your income and your expenses. It could have been that you hit the end of the month and you had more month than paycheck. It could be that you're using credit cards and running in the negative on a regular basis, or you've used a home equity line of credit a little bit too much, or any kind of line of credit, and you're underwater financially. You want to get your own financial house in order. Get things leveled out and start budgeting. Make sure that you're living under your means. And I know that sounds like it's no fun, but chances are you're wasting a lot of money on stuff that you don't really use. Look at all of the different subscriptions that you've got that you're not really using anymore. For me, with my business, it's a lot around, software and software as a service type things. It's 10 bucks a month, 40 bucks a month, 50 bucks a month. Well, that stuff might not be very much looking at it individually, but cumulatively over time, it really, really adds up. Heck, I just did a little bit of housekeeping myself with my own business and easily cut out $700 a month in recurring fees that had just kind of snuck up on me. So what is that like in your personal life? What are the recurring fees that you're paying that you're not really using? Do you really need that paid Spotify account? Do you really need all of the different streaming platforms that you might be on? Do you need Netflix and Prime and Paramount and Disney and all of those different things that just, financially, it's death by a thousand small cuts, right? So you want to tighten those things up. How often are you eating out? What kind of a car? Are you paying way too much for a car? Are you leasing a vehicle when you could buy a good used vehicle? These kind of things. Take a break, from trying to keep up with the Joneses and look like you got a lot of money if you don't have it, right? So just be honest about where you are. This reminds me of an inspirational story I heard from a gentleman that I interviewed on my podcast the other day. And he and his family decided to sell their primary home and move into one of their rentals. So that was a big step down from them. But by doing that, he freed up a ton of equity from his home that he could now deploy for buying more properties. That is a very smart financial decision. So take a look at where you can tighten things up, lower your expenses. So lowering your expenses is just one way to create more money that's available at the end of the month. The other way to create more money at the end of the month is to make more money, right? So start a side hustle. Get a second job perhaps, or start a side business, not just for spending on toys and recreation, but that's specifically earmarked for your real estate fund. So all of the money, all of the profit that you're generating from that goes directly into that forced savings account. That is a great way to combine with lowering your expenses to really get out of debt and then start saving up for that down payment. Something else that you might want to look at is if you have some retirement funds kind of floundering around in mutual funds or what have you, maybe consider taking those and putting them into a self-directed type of account. And that way you've got control over them. Now, depending on where you are and what the rules and regulations are, different in the States versus Canada, for example, you may be able to use those funds to invest in an investment property. Now, maybe it might not be your investment property. It might be in somebody else's property. But here's a trick that I've seen a lot of people do, especially up here in Canada, where we can't use our own self-directed funds to buy our own investment property. What they do is they do a swap. So for example, you find another real estate investor who also has retirement funds kind of sitting around. You both get them into self-directed accounts, and then you loan each other money, okay, for your specific real estate deals. So for example, let's say your friend Bob has $100,000 in retirement savings, and you've got $100,000 in retirement savings. You could invest in Rob's deal, $100,000 in Rob's deal, which he might secure with a second mortgage on a property, and you're getting a nice fixed return on your money that's coming in on a regular basis. And then in turn, you borrow Rob's fund to purchase your next investment property or to put on a second mortgage on one of your properties. And that's how you're able to access those funds. You're not accessing yours directly, you're accessing somebody else, but at the end of the day, when the smoke clears, it's the same idea. Now, you just got to make sure that you're investing in somebody that you have complete confidence in. I would recommend that you meet people and get to know them at your local real estate investment club or RIA or what have you, and get really comfortable that way first before you cut that check. And then last but not least, if you've owned your own property for some time, chances are you've got some equity in there that you could access and use that as a down payment for your next revenue property. So if you've got access to $50,000 or $75,000 or $100,000 in home equity, why not get a home equity line of credit and then use that money to buy that next property? So there you have it. There's a couple of different ideas on how you can start saving up or accessing your capital to invest in real estate. Now, once you've done that, you don't need a lot of them, but if you've got one successful deal under your belt, now you're ready to scale. Now you're ready to start using other people's money. If you want to do that, I've got a great resource for you. It's my book, The Money Partner Formula. You click on the link in the description below or go to investorattractionbook.com. Get your free copy today.